Now, differentiating between economic and regulatory capital. So economic capital, as we know, it is something which is calculated from the internal model. So it is the internal measure of capital requirement for the bank. It is also the amount of capital which is determined based on the solvency standards of the bank in order to ensure that they continue to remain as a going concern. Now, this is something which will be worked out by the bank's management, and that way they will then use an internal model to estimate how much is the economic capital required. So it's also a measure of capital that aims to support various business decisions. So as we mentioned earlier, any kind of business or strategic risk for the bank, that is something which gets taken care by the economic capital idea. And this also helps the bank's management evaluate the business functions per unit of risk taken by them. Because as we know, a bank is a very large organization. And within the bank, you have multiple business units which are doing their respective operations. So let's say you have commercial banking units, right? So whereby you have, let's say, for example, retail units as a part of that. You have retail units, you have commercial banking, you have trading, you have investment banking, etc. So that way, these are different business units which form a part of the broad bank. And every business unit is going to carry a certain amount of risk. That is because any kind of operation which they engage in. So imagine that we have a corporate lending or maybe retail lending function which we are talking about. Now, these functions are going to be exposed to the inherent risk of lending because some borrowers which they do business with, they are expected to default. So that brings in the kind of uncertainty or risk. So that way, economic capital also helps in evaluation of business functions from a profitability point of view. Because finally, a bank is there to make commercial business and they're there to make profits. So that's why how exactly every business unit is behaving and what is the profitability, that becomes paramount. And for that purpose, this evaluation becomes very, very important. So ideas like funds transfer pricing, etc., are somewhat related to this concept as well. So for example, a bank's management will decide how much amount of capital will need to be allocated to a business unit based on the desirable profit per unit of risk. So this is something which is going to come from your FTP model as well, or this can be like one of the inputs which goes into the FTP model. So for our readers who are unfamiliar with FTP, FTP is what we call as funds transfer pricing. So FTP is an important mechanism, or I would say it's like a management decision making tool which helps the management get a clear-cut view as to what is the kind of profitability which is being generated by respective business units. So that basically gives them an idea as to which business unit should be incentivized and which business unit should be penalized. And for that purpose, these kind of tools like FTP come very, very handy. Now, economic capital is very bank specific because as we know, every bank will have a certain business model which they follow. So that way, as the business model across banks is different, the kind of risk which is being carried, that is different as well. And that's why we say that economic capital is very bank specific, and that will vary from one bank to another. So it cannot be like a blanket rule. So imagine that you have a large bank, let's say a lender in a certain market, they have a certain economic capital. Now, those similar models cannot be applied by a smaller bank in that particular market because firstly the size of their operations is different, their strategies are different, also the business models are different as well. So that's why management is going to spend a considerable amount of time and effort in order to have a well designed capital model which is very much applicable to their business as such. So that's why it's very bank specific. Bank's long-term strategy also plays a role in determining the level of economic capital because finally it is the long-term strategy which is very, very important. So a very simple example of what is long-term strategy. So for example, let's say a bank decides that they want to become the largest lender in a particular country over the next 10 years. So that can be thought of as a long-term vision or the long-term strategy for a certain business. And accordingly, these kind of strategic decisions will play a very significant role in determining what is the kind of economic capital which the bank needs to maintain. Now, economic capital also plays a role in determining leverage. Now we know the idea of leveraging. Now we know that when we talk of leverage, that is something which is going to help a bank magnify its profits. Also, at the same time, the flip side, if things go wrong, the bank can run into a lot of trouble as well. So a bank that allocates very small amount of economic capital, they're taking a high amount of leverage. Now, why we say high amount of leverage? Because let's say it's a very aggressive bank and they want to really grow very, very fast. So the bank's management would make a decision that fine, we are going to follow an aggressive strategy. So for that purpose, we are going to allocate lesser amount of capital in the form of economic capital, and the remaining balance, that is something which we are going to use to pursue our business. That is, that additional capital which is getting freed up, that is something which the bank is going to consume for growing its lending business. So this is something which you'll observe commonly for an aggressive bank or a bank which wants to grow quickly through an aggressive strategy. Now, nothing wrong with it, but again, it's always important to understand the pros and cons of these kind of approaches, because as we know, every bank is going to have a different perception. Not everyone is going to follow an aggressive strategy, right? So by taking more leverage, the bank naturally has a potential to generate higher profit. Now, again, the word potential becomes important. There's no guarantee on generating high profits, because if the bank is able to do good business through this excess amount of capital which is getting freed up, then yes, naturally it will stand to gain better and it will be able to generate higher profits. However, the thing is, it can risk itself to its very existence or solvency, because if the market situation worsens and it worsens very, very quickly, then the bank might find itself very difficult to meet its obligations and its solvency might come into trouble. So that's why that is one risk the bank will need to take care if they're following an aggressive strategy. Also, another risk is, just an elaboration of the solvency point. So naturally, if the bank is exposed to solvency risk, then there are problems that whether the bank can continue to be as a going concern or whether it needs to then ask for a regulatory rescue, etc. So all of these problems can follow. So that way, a bank's management will need to make a judicious decision as to what is the level of economic capital which they would like to work with and what kind of strategies do they have in mind. Do they have a very aggressive strategy or a not so aggressive strategy, etc. And that will play a role in determination of how the economic capital scenario for that particular bank is going to pan out. Now, coming to regulatory capital. Now, regulatory capital, so everyone is familiar with the idea like the Basel III capital rules. And going ahead, we expect FRTB to come in as well. So Basel III has been around for a very, very long time, and that is a regulation which banks use globally in order to calculate the minimum capital requirement which is required for regulatory purposes. Now, why regulatory capital becomes so important? Why do regulators insist that a bank has to satisfy the regulatory capital requirements on a daily basis? The reason for that is given below. Now, banks hold a very, very large portion of retail deposits, and this is sitting on the liability side of the balance sheet. Now, if there is any kind of defaults by the bank, now these can be detrimental to customers. So naturally, customers are going to lose money and they are going to lose confidence in the banking system as a whole as well. And that way, these can be strenuous for the overall economy as well. To avoid such an eventuality, i.e., that is to avoid the possibility that the bank is not going to honor its obligations, and that is something which can be detrimental to its customers. Regulators are going to insist that the banks follow a very, very rigid and a very strict guideline when it comes to regulations. Now, there are no two ways about this. Now, a bank needs to ensure that they are always on the right side of this regulation, because any kind of discrepancies here is something which is seen very, very seriously, and the regulator will not tolerate any kind of deviations or if a bank is unable to maintain its capital requirements. So that's why you'll observe that every bank will ensure that they're allocating something which is probably more than what is the regulatory requirement, so that they ensure that they are always meeting these regulatory standards on a day-to-day basis. So it's on a daily basis thing. Now, if regulatory capital is less than economic capital, So basically, if economic capital exceeds the minimum regulatory capital required, then the bank is free to maintain this economic capital. Now, this means that it is more conservative in nature, and regulators will certainly see this as a more positive side, or maybe they'll see it as a positive for the bank. Now, if regulatory capital is greater than economic capital, i.e., the economic capital is falling short of the regulatory capital, so that means the bank would like to pursue an aggressive strategy and it is willing to take on more leverage, the same point which we spoke of earlier. So the bank has an aggressive strategy, it wants to grow, and so it has taken for this additional leverage. Now, in this case, the bank is expected to maintain at least the minimum regulatory capital at all times. Now, for regulatory purposes, capital on the balance sheet is accepted for the regulatory calculations. So we have the common terms like Tier 1 capital, Tier 2 capital, etc. Now, a few of the components which go into Tier 1 and Tier 2 have been mentioned here for your information. Now, although the regulatory capital is based on what is there on the bank's balance sheet, and there are certain drawbacks to the way in which things are calculated. So, as we have mentioned here, now equity is a residual claim on the assets, and therefore these are kind of difficult to measure. Also, equity is calculated based on the historical cost, and this historical cost could be far from what are the current market value of that particular equity. So there can be a discrepancy. Now, even if the market value is intended to be used, the problem is most of banks' assets, they are illiquid in nature. So naturally, we know that whenever there is something which is illiquid, then it is very difficult to estimate what is the fair value for that particular asset. So therefore, even if we have to use the market value approach, it can become difficult because banks' assets are predominantly not liquidly traded in the broad market, or majority of them are not traded liquidly. Also, regulatory capital ignores off-balance sheet items. Now, a quick recap of economic versus regulatory capital. We have discussed both of these ideas, so let's try to quickly summarize them for our convenience. So, regulatory capital, the bare minimum regulatory capital which is demanded by regulators, and bank needs to maintain this at all times. Now, regulatory capital can be thought of as the sum of market risk capital, credit risk capital, and ops risk or operational risk capital. One thing to remember about regulatory capital is we do not recognize diversification benefits. So that way we can imagine that there are three separate teams, let's say a market risk management, a credit risk, and an ops risk management. They are going to calculate their respective capital numbers for a certain bank. And then these are going to be summed up in order to come up with the regulatory capital. As simple as that. Now, contrasting this with what do we do for economic capital? Now, economic capital is something which will come from the internal models which have been developed by the bank. Now, regulators can prescribe the kind of assets to be used as economic capital. Also, as we know, economic capital is allocated to individual business units because, as we know, the profitability of individual business units is paramount for the overall bank to remain profitable. For that purpose, usage of economic capital allows the comparison of performance between different business units, and that is something which will help in making a strategic decision as to whether the bank wants to grow a certain business unit or they want to either shrink or shut down a certain line of business as well. Now, economic capital can be thought of as a summation of all of these capitals, and one important point which differentiates regulatory with economic is the diversification benefits. So we do consider the diversification benefits which come in as well, and this is like a formula for economic capital which can be applied.